On this Emily Now episode, we'll be talking about the financial statements that your business needs. We'll be discussing what a pro forma cash flow is. I'll be reviewing a file that we had that came through where a business owner had acquired a few of his competitors, and I'll talk to you about how he put that deal together, how he financed it. And lastly, there was some news this week about crowdfunding. A Calgary startup launched their first successful crowdfunding opportunity, and so I'll be discussing that a little bit. Don't go anywhere. My name is Dylan Gallagher. I'm the founder of mlenow.ca. I've been a finance guy for the past 18 years with a focus on debt, mortgages, and loans, as well as working with private investors to manage opportunities on their behalf. We put these weekly Emily Now episodes together to teach you a little bit about what's involved in borrowing money, in some of the market trends and the latest news that's happening, because we believe that if we can give you this sort of information, that you're going to be in a position to make better borrowing decisions when the time comes. Maybe you'll learn something new about finance that's going to help you or your business. And ultimately, we want to help you do more. We believe that if you're able to do more, that the savings that comes from that or the investment that gets made ultimately allows you to give back to the community around you, invest in your business, or maybe save for a rainy day, maybe when the next economic downturn comes. So our goal is to help prevent that from happening, but to encourage you to find ways to save money and to do more. And so that's why we put these episodes together. We would encourage you to visit us online, mlenow.ca. You can follow us on Twitter at @EmilyNowCanada. We are also on Facebook, Google+, and of course you can subscribe to our LinkedIn channel so that you can do more and learn how to do that. We start off each segment with a couple of questions. Today's first question that I'm going to be talking about is, what financial statements does my business need? I talk about this every day, all the time, and so it becomes a bit of a broken record for me. But basically, there's two types of financial statements that you, as a business owner, definitely need to know about. You have a balance sheet and you have an income statement. An income statement is also referred to as a profit and loss statement. And they're not the same. Most business owners just assume when they hear financial statements that it's a kind of a catch-all phrase. But the reality is there are lots of things that go into financial statements. But basically, for purposes of borrowing money, there's two distinct statements you want to take a look at. One is a balance sheet. The other one is your income statement. Your balance sheet says what do you own, what do you owe. Your income statement says what do you earn and what do you spend. And those two statements work together to determine how well your business is doing. In my experience, businesses use their income statement all the time. You can talk to any business owner and they'll say, oh, our revenue this year is going to be $1 million or $5 million. And if you press them, you might be able to get them to tell you what the net income is going to be. So after we pay all of our expenses, we're going to have $500,000 this year, or $250,000, or $5 million. But then if you ask them what the implication is to their balance sheet, how much debt did you pay off, or how did the money move through your business? How do you know you're in a better position this year than last year? Most business owners will say, well, we did $5 million in business. It was a great year. But when you don't understand how the financial statements work together, you can often find yourself in a position of saying, I don't understand how we make so much money and yet we have nothing left over. And so I would encourage business owners to take a look at their balance sheet. After you've earned your money and you've spent it on expenses and there's some left, then you need to understand, okay, so what was the impact to what we own and what we owe? And are we in a better position this year than we were last year? One of the very quick things you can do, if you have your financial statements available, or if not, you can pause this episode, go get them and bring them back. But on your balance sheet, there should be a line item near the bottom that says retained earnings. That's a pretty important line item that helps link the two statements together. And your retained earnings basically tell somebody like me or a bank or even you what the cumulative effect of all the money you made and all the money you spent was. So if that number is positive, chances are you've got a healthy business. If the number is negative, then it means that your business simply doesn't have the cash it needs to meet its obligations. I'm oversimplifying it, but the point is that if you're a business owner that looks at their profit and loss statement, what did we earn, what did we spend, what's left, that you should also spend some time looking at your balance sheet. What do you own, what do you owe, and what's left? Banks want to know, most importantly, how cash is used in your business. And so when they look at your financial statements, they're looking not just for revenue and expenses. They're really concerned with, over the period of the loan that we're giving you, so if it was 5 years or 7 years, how does our loan balance shrink? How does the equity in your business grow? And if you added our money to your business, is it actually helping your business achieve something, or is it just glossing over problems that your business has that you need to spend some time fixing? Your accountant should be able to help you identify the areas in either your income statement or probably more in your balance sheet that need to be improved. So the classic place that I start when I look at a balance sheet, of course, look at retained earnings. The very next thing I look at is accounts receivable and accounts payable. If your receivables in your business, you're expecting payment from customers, and let's say it's $200,000, but your payables, the bills that have to be paid by the business, are $300,000, well, you've got a $100,000 shortfall, and that's a problem. So that's an example of something that your accountant, either your in-house accounting team or your accountant who does your year-end statements for you, should be able to sit down and identify on your balance sheet. They should walk you through your financial statements and show you the areas that you need improvement. If you're looking for a business loan, then it's really important that you understand what your financial statements have to say. And of course, you can use mlenow.ca to get a very quick idea of what that needs to look like. So if you punch in a loan amount, it's going to tell you how much equity your business needs, how much net income it needs. But even without mlenow.ca, you yourself, if you're going to go and talk to a bank, you should know what they're looking for, and you should make sure that your financial statements reflect what the bank is going to want to see. And there's lots of help out there available. There's lots of websites, there's lots of tutorials, but the best person to talk to is your accountant, and they should be able to help you with that. Our second question today is, what are pro forma cash flow statements? Pro forma cash flow statements, pro forma means projection or looking into the future or what you anticipate your financial performance to be without making big adjustments. And it doesn't just take your revenue and say in year 1, year 2, and year 3, here's what our revenue is, here's what our expenses are, and here's what we hope to make. It takes that one step further and says, okay, now how does that impact our balance sheet? How does our revenue less our expenses build the equity in our business? And so it means it has to flow into a balance sheet. So pro forma financial statements are basically your income statement and your balance sheet projected over time. I find this is probably the hardest thing for businesses to put together when they come to talk to me or when they're going through mlenow.ca to get financing. One of the things that they're required, one of the things that a borrower is required to provide is a set of pro forma financial statements. What do you think your income statement and balance sheet are going to look like over the next 3 years? And business owners scratch their head and they really have a hard time with that because they're not very comfortable with how the balance sheet works. They know how their profit and loss statement works or their income statement, but they really come up short on trying to figure out how to get that information to flow now into the balance sheet. Every business needs pro forma financial statements, and the typical period is 2 to 3 years. You should have a line of sight as to what your business is going to do over the next 2 to 3 years, and that should be reflected in pro forma financial statements. What is the financial state of your business in years 1, 2, and 3, or in the next 1, 2, and 3 years? They paint a picture of what your business expects to do, and most importantly, if in doing the pro forma financial statements properly, what you're going to realize is how are we paying for the growth of our business? That's ultimately what a pro forma financial statement will show. How are we growing our business, or how are we maintaining our business from a cash perspective? Is the business generating enough cash to support itself over the next couple of years? Or, as most businesses experience, are we going to need an injection of cash at certain points? That injection of cash can be equity that the owners of the business put in. The injection of cash, a lot of times in what we do every day at mlenow.ca, is to help find some financing. So find 5-year or 7-year money that can be lent into the business to help it grow to get to the level that it needs to. But your pro forma cash flow statements answer this question. So if you're not going to prepare them because you think the bank needs them, by the way, that's a really valid reason for doing it, then do it for yourself. Because as a business owner, you should know how is the business going to pay its expenses as we grow into the future. Where is the cash coming from? Some businesses are in fact able to pay for their growth out of earnings. And so what will happen is a business will start out, they'll get to a place of where they're mature and their earnings are predictable, their revenue is predictable, their customers are predictable. But if they want to get to the next level, that typically doesn't happen from cash flow. They typically need new money to come into the business for a period of time until the business gets to the next level. And pro forma financial statements would help you understand what the implication is of that. Your in-house accounting team can definitely help you with this, but it might be a good idea to get your accountant who does your year-end financial statements to give you a bit of a head start. Maybe they can either give you a template to work with, a format to work with. Maybe they prepare them first for you in a draft form and then give them to your accounting team so that the accounting team in your business can then modify them and tweak them and figure out, okay, does this really reflect what our business plan says we're going to do and how we're going to pay for our growth? You should review them regularly, but at the end of the day, there's only one thing that you remember. Pro forma cash flow statements tell you how your business is going to pay for itself in the coming years. A real life example this week is a business owner whom I've come to enjoy working with. Very entrepreneurial, very intuitive and smart. Started a business years ago, and as the years went on, ended up not only purchasing one competitor slash complementary business maybe, but he also purchased a second one. So in his given marketplace, he owns now 3 businesses that his one customer, so if they had one customer, they were going to sort of 3 places to get the 3 services or products that they needed. He was able to purchase those 3 companies, bring them somewhat all together, and now doesn't control the market, but certainly has his hands around it. And it's been exciting to watch from the sidelines. We had a chance to broker some financing for them last year. This year, with their latest acquisition, now we're looking at doing some cleanup. And the reason for that is, like most businesses that are starting out or don't have maybe they're not in the financial position that they need to be in order to go directly to the bank to get financing. We're here he borrowed money from his personal net worth. So he got some mortgages and some loans and used his personal credit and net worth to push money into the businesses that then pushed the money to go and make these other acquisitions. So now the acquisitions are over, but his personal resources are totally drained. The 3 companies all generate great revenue, great net income, but he's still sorting out, they've just moved to a new facility to try and bring these 3 businesses under one roof. And so cash, for a business owner, cash is always tight, but in this particular case, it's especially tight. And so the work that we're going to be doing here over the next couple of months will be to take these 3 businesses, get them the right financing that each of them need in order to be able to perform properly, and hopefully maybe deleverage his personal net worth a little bit so that him and his family, in fact, can breathe a sigh of relief. For us, it's pretty typical to see this. We often see that business owners will leverage their personal net worth to make something happen. And that's not a bad thing. But if you don't have a plan for getting your net worth back, then that produces problems. And entrepreneurs, God bless them, being what they are, they tend to act first and think later. And in this particular business situation, the business owner made a very conscientious decision to say, I need to purchase these companies because I'm more interested in grabbing the marketplace than I am spending a lot of time overanalyzing the deal. And the trade-off for that is that he paid a lot for the money he needed by virtue of having to leverage his personal net worth, and now has to spend a bunch of time trying to figure out, okay, how do I get the right financing and kind of what financing is involved. In addition to seeing that business owners tend to jump first and think later, he also has a flat management style, which means everybody reports up to him. So for our team to get the information that we need to package up his requests and get them out to the marketplace, we have to rely on him. And so what happens is 1 week turns into 2 weeks, turns into 1 month, maybe even 2 months. And so if you're a business owner and you find yourself in this position, I would strongly encourage you to delegate down the information gathering exercise to somebody else on your team that can get it to the people that they need to. And this isn't purely for efficiency, but the reality is that in the case of this client, every week that goes by, the interest clock continues to tick at a rate that is double digits when you take kind of all of the money that he's borrowed and figure out how much it's cost him. But it's double digits. It's costing him real cash. It's also costing him stress and angst and frustration. And so don't let that happen to you if you're a business owner. Make sure that if you're going to jump and not think about it till after the fact, that you have somewhat of a plan or a line of sight to how you're going to ultimately have the pieces picked up. And if you don't have a plan for that, then make sure you've got some people around you that are able to help put those pieces together. And of course, at mlenow.ca, we could be one of those people. Wanted to talk this week. Some interesting news came out of, there was a Globe and Mail article that was run, and it was titled, Ordinary Investor Buys Stake in Company Online. And it went through in detail the new Calgary-based startup company called Seed Ups Canada that connects early-stage companies with potential investors. And it's a new movement known as crowdfunding, where I guess a crowd of people provide money to a new business or a new business venture, but they do it online. So a business will say, we have a new business and we're looking to raise $250,000, and they advertise online or through social media through a company like Seed Ups Canada, and someone will say, I'll take $500 or I'll take $1,000, and ultimately they raise the money through a campaign, and the people that put the money in get some ownership in the business. So it's a new trend that has come along because of technology, because of efficiencies, because of people. I think it's because of more and more people are comfortable online conducting financial transactions, that making investments in this type of an opportunity was sort of the next natural progression of how individual investors can participate in what traditionally would be, investments that only institutions could make. It's massively popular. It provides people with the opportunity to invest in companies or new opportunities that they might not have been able to do otherwise, because maybe they didn't have the connections, or maybe these opportunities just simply weren't available. But I was talking with somebody this week, and because I've been doing what I've done for 18 years, I've seen lots of trends come and go, some business concepts work and not work. And so in the capital raising world, the way it sort of worked a decade ago was you would advertise in a newspaper, and you would say, we're going to have a little event tonight, an investment seminar, where we're going to give you some milk and cookies, and we're going to walk you through the latest opportunity that we have. And for a while there, land was the most popular one. You'd get people that would come out to these investment presentations, and they would own a share or an interest in a piece of dirt. And that's sort of how it was done. So these promoters would put these opportunities together. They would make sure all the paperwork hopefully was in place, and then they'd bring people out and they would do this road show, if you will. So for me, it feels like crowdfunding is kind of the next evolution of that. And it's not efficient to get people to come out for milk and cookies into a seminar room and talk to them about the latest investment pitch. People's schedules are very, very busy. Everyone's time is so compressed that they really, I think it's very tough to keep people or to capture people's interest that way. I think that crowdfunding, going onto a website, looking at an opportunity, as long as it's presented properly and clearly, and all of the backup information is there, that sort of seems like the right evolution of how people would raise money for new opportunities. But this doesn't change the fundamental rules that I don't think have been altered since the beginning of time. And that would be that if you're an investor looking to make an investment in anything, you still have to do your homework. You still have to know what you're investing in. You have to know what the risks are. You have to know whether or not you can afford the risk. So what I mean is, if you invest money into an unproven opportunity, if you were to lose that money, does your financial life fall apart? Or could you take the loss and not suffer a lot of change to your life? So even though crowdfunding is a big deal and it's very interesting, there's lots of companies that are doing it all over the world. Seedups Canada has a unique approach to what they do, because they have worked with the securities commissions in Canada to make sure that what they're offering is not only legit, but it's done professionally and properly. And so as an investor, you should be able to have some comfort in that. But it doesn't change the fact that no matter what you're doing, whether you're going to a seminar to have milk and cookies, to listen to someone pitching a piece of land or an apartment building or an oil and gas company, or you jump online and you look at some of these crowdfunded opportunities, you still need to have a pretty good understanding of what you can afford to do, what you can afford to lose. And there's lots, with the age of information that we live in today, there's lots of ways to get what you need. In fact, I think some people would argue there's just too much information out there. But inevitably, investments are going to go bad or they're going to go wrong. Investors need to proceed with caution all the time. And so I'm quite excited by this opportunity. And that's because, of course, we too have an online platform, mlenow.ca. It's not a crowdfunding opportunity, but it is a step in what I believe is the next evolution of how people will borrow money. I believe that people will use the internet, will use technology to put their information together before they start sending it out to banks and lenders for approval, or before they start talking with real people. They're going to want to know that they can get approved, in essence. And so technology continues to play a very big part in the financial services business. And to that end, I would encourage you to visit mlenow.ca if you do need a mortgage or a loan. We've made it really, really simple for you. Simply enter a mortgage or a loan amount. It's going to prompt you through the next series of questions, and as you answer those questions, you'll get a chance to sort of see where you think how you're going to be approved and which banks and lenders in Canada can approve you. And so we have a live chat option there. We also have real people behind the live chat, so if you want to call us or email us, we'd be happy to help you. And we look forward to seeing you on the next Emily Now episode. Thanks for watching.